The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. So let's get a check on these markets.
Let's do it.
Shall we? We're taking a look at the majors right now. You can see the S&P 500. We're looking at slight gains, and I stretch slight, just about 0.1% higher. The reason why is because tech is not cooperating today. The Nasdaq 100 down about 0.4%. We've seen some weakness there. We know we have some of the big names reporting tomorrow, so watch that line. I threw up the Russell 2000 because small caps outperforming today. This index up nearly 1%, and it might be because you're seeing a rally in the bond market. The 10-year Treasury yield, Scarlett, currently down about 4 basis points. We are knocking on the door of 4.3%.
Remarkable. And as you mentioned, tech stocks are stumbling on the eve of earnings from a pair of Mag 7 names. Alphabet on the defensive over how Gen AI is eroding its bread and butter search business, while Tesla needs to clarify what its long promised ramp up of robo-taxis actually looks like. Now, the Fed may be in its blackout period, but everyone else is talking about the central bank. Treasury Secretary Scott Bessent says he sees no reason for Jay Powell to step down as chair, even as he says Powell should leave early if he wants to. And meme stock mania strikes again with the S&P 500 and Nasdaq near record highs. Retail traders are pumping up Opendoor, those shares jumping more than 300% over the past 7 days. And department store Kohl's, whose mentions on social media coincide with a 50% rally this week. So that's, detached from fundamentals, but it all comes back to earnings and how it's playing out on the market so far.
Yeah, and it's interesting. I feel like you have all these single stock stories and volatility when it comes to single names, but then you take a look at the big benchmark, the S&P 500. I thought this chart was amazing. We haven't seen a move of more than 1% in either direction in over a month. We haven't seen a move of that magnitude since June. And it's unintuitive, Scarlett, when you consider all of the trade headwinds that we're dealing with. Of course, now we're getting into the heart of earnings season. So you have a lot of these names moving in a big way, but still it's not really making a difference when it comes to the big benchmark, which, as you say, is hovering near a record high.
Absolutely. So let's kick things off with Lizanne Sonders, Chief Investment Strategist at Charles Schwab. And Lizanne, as Katie was showing us, not a whole lot of movement in the S&P 500 on its own. The VIX at about 16 shows a lot of calm despite this continued uncertainty and pockets of tension, certainly across the economy and in parts of the market as well. Investors seem to have decided not to focus on potential trouble spots, the downside from tariffs, until it matters. What will cause that to matter again?
Well, I think obviously the August 1st latest deadline matters. We'll see whether that gets extended again. Second quarter earnings season matters because analysts are essentially forcing companies to try to put meat on the bones in terms of those companies that are impacted by tariffs. What has been the impact to date? Are they planning on, or are they eating it in profit margins? Are they passing it on to consumers? What is their pricing strategy? What is their pricing power? So I think we're really in the meat of when we're going to start to maybe quantify some of this a bit more. And then I think, Fed policy as well. I have a bit of a contrarian view, Scarlett. I actually think that part of the reason why the market has done fairly well is because the Fed is not cutting, not the market anticipating that the Fed is going to cut. Neither side of their mandate suggests it's appropriate. And I think that also maybe is why there's a bit of calm in the bond market as well.
So when you say that the market's doing well because the Fed is not cutting, that's because it's a reflection of the solid economic fundamentals?
So far, anyway, solid economic fundamentals, not to mention the fact that we don't have tight financial conditions. They're actually fairly loose. So you've got the dual mandate, neither side of which is suggesting the Fed should imminently make a move here. The inflation is not accelerating significantly, but it's not down toward the Fed's target. The unemployment rate has come down a bit. There's enough resilience in the labor market that side of their mandate is not suggesting they should do something. And then the other issue, of course, is we can talk about the benefits perceived or otherwise of taking short rates down, but this notion that that is going to benefit, say, smaller caps or mortgage rates is only if you see longer term yields move down commensurate with shorter term yields. We could have a repeat of what happened last fall, where when the Fed cut the Fed funds rate by 100 basis points over that same period of time, almost to the day, you saw a 100 basis point increase in the 10-year yield. That's the feeder into the equity market, into corporate financing, and into things like the mortgage rate.
Well, let's talk a little bit more about corporate America through the lens of earnings, because we're really getting into the meat of earnings season. We have some of the big tech names taking the stage tomorrow, and it seems like so far it's pretty rough out there. You consider the reaction function that we're seeing to the companies that missed. Bloomberg Intelligence estimates it's the harshest punishment in about 3 years' time. Lizanne, what does that say about the state of sentiment at this moment?
You know, it's interesting because the actual earnings bar has been set relatively low heading into second quarter reporting season. You know, you had a very strong first quarter reporting season. When all was said and done, earnings were up 14-15%, which is almost double what the expectation was at the start of first quarter reporting season. But there was no extrapolation of that into the remaining 3 quarters of the year. So arguably, numerically, the bar has been set low, but I think psychologically is where the bar has been set higher. And that's why you're seeing stocks of companies that have missed disproportionately hurt on the downside relative to the rewards accrued to stocks of companies that have beaten estimates. And I think that kind of trend is likely to continue. More punishment for the misses.
That's a really interesting separation, that maybe when it comes to pure numbers, the bar was lowered heading into this season, but the psychological bar is maybe much higher. So that's the missing conversation. When companies miss, they're getting disproportionately punished in this environment. What about the companies that actually meet or exceed expectations? Are we seeing on the flip side those companies being rewarded?
No, to a mild degree, but nowhere near proportional to how much the misses are getting hurt. And that's not a brand new trend this quarter. That's been the last couple of quarters, and I don't think we see an improvement other than maybe extreme beats on the upside that go well beyond what the analysts were expecting, provide an outlook that is rosier than what was anticipated. Aside from that, I would expect to see muted impact on the stocks of beats, much more of a focus on where are the hits coming.
Lizanne, you had mentioned earlier that the economy is doing well, and in part because the Federal Reserve is not cutting interest rates. It also, you've mentioned
the market doing well.
The market doing well. Excuse me. Yes. Yeah. Thank you. I misspoke there. But you also noted that the rally that we've seen since the lows of April has retail traders' fingerprints all over them. And I'm curious in terms of what you're seeing that proves that, and what that might say about the durability of this bull market.
Yeah, you can look at the factor level and you can look at the basket level. So very popular baskets put out by Goldman Sachs. You can array them and look at where under or outperformance is. And it's an interesting array since the closing low on April 8th, because the biggest outperformers at the basket level are things like non-profitable tech, retail favorites, heavily shorted stocks. On the flip side, the biggest underperformers since the April 8th closing low are baskets like the defensives and bond proxies. So there's a bit of a lower quality tilt to what's working, but it's a lot of those cohorts that are favorites of the retail crowd. I think what's also interesting about the heavily shorted stocks also doing well, it's suggestive of the move by retail traders to buy the dip in the intraday lows on April 9th and continue to buy on the way up actually forced some repositioning on the part of institutions that were left somewhat flat-footed when that rally started. So that short covering has been part of what has propelled the market higher. Those are arguably still lower quality stocks, but that's an area where you see this blend of retail trader footprints and maybe what that's forced institutions to do.
So how does that affect people's positioning going forward? If you're observing that and seeing a tilt towards lower quality names, how do you think one should position themselves for the upcoming weeks where we can get a lot of news when it comes to tariffs?
So I think in the aggregate, the pain trade is probably still higher because institutions are not positioned in risk on mode. That said, there is a lot of complacency, and I think the market would be subject to another pullback. We've had mini ones, obviously the big one from mid-February to early April. I think the market might be prone to that given complacency if we get some sort of negative catalyst. So I think the way to think about positioning is I would, using traders lingo, I would fade the low quality areas that have done well, take profits there, lean in up the quality spectrum. Even if the market continues to rip, they may not be the biggest outperformers, but they'll continue to do well in an absolute sense, but probably also represent some ballast in the event you get some sort of catalyst driven pullback in the market or correction in the market. That was certainly the case during that mid-February to second week in April period of time. So fade the low quality, lean into the high quality.
It's a delicate needle to thread, right? Because the risk, as you say, the upside risk, the pain trade here is a big move higher, but at the same time, you want to fade some of those lower quality names. But what does higher quality mean to you? Because for a lot of investors for so long, that has led them to the tech sector.
Yeah, and I think that there's still plenty of representation within some of the high-flying, growthier sectors like comm services and technology. The factors that we are focused on that would arguably have that high-quality umbrella around them, some of them are generally high-quality factors like strength of balance sheet, strong free cash flow, but maybe more targeted high-quality factors for the unique period of time we're living in right now. So stability or strength in profit margins, forward-looking positive outlook from an earnings perspective, so positive revisions, high interest coverage. So some of those balance sheet related high quality factors, I think, are where you want to focus. Almost the way, I've been doing this almost 40 years, thinking back, 20 years or so, when GARP was the popular acronym, growth at a reasonable price. I think you want that blend. You don't want to sacrifice growth in order to find value. I think you want to look for the blend of those. But apply that analysis and screening across all 11 sectors. You'll find opportunities in the growthier sectors.
All right, good stuff. Lizanne, really appreciate your joining us today. Lizanne Sonders is Chief Investment Strategist over at Charles Schwab and bringing back the GARP mantra of investing. Coming up, we'll talk to Deputy Treasury Secretary Michael Faulkender about all of the administration's top economic priorities, including the next phase of trade deals and the fate of Fed Chair Jay Powell.
Plus, the private equity fund Harbinger Sports is looking to score big as sports valuations soar and teams look for fresh capital. Partners Rashaun Williams, Steve Cannon, and Jonathan Mariner join us to discuss where they're seeing gold medal opportunity.
And as consumers and retailers await a clearer tariff picture, we'll speak to the CEO of Catalyst Brands about how his portfolio of retailers, including JCPenney and Aeropostale, plan to keep shoppers walking through the doors. That's coming up on The Close. It's time now for our top calls, a look at some of the big movers on the back of analyst recommendations. And we'll start with Shopify. Loop Capital Markets downgrading its recommendation to hold from buy while maintaining its price target of $120. Valuation was the analyst's reasoning behind the shift lower, saying investors should wait for a more attractive entry point. The share's down about 3%. Next in line on holding, Raymond James cutting the sportswear company to outperform from strong buy and holding its $66 price target. The firm cites near-term macro headwinds for the downgrade, but does remain bullish in the long run. Shares down by almost 5%. And finally, Cleveland Cliffs. KeyBank upgrading the steelmaker to overweight from sector weight and setting a price target of $14. The analyst sees an improving risk-reward ratio, especially given the steel company's cost efficiency measures. You can see there the shares up almost 7% on the day. And those are some of our top calls. We are also watching Coca-Cola. The shares down by about 0.75% after the soft drink maker's second quarter sales growth and profit beat analyst estimates. Here now to discuss is Peter Galbo, Senior Consumer Products Analyst over at BofA Securities. Peter, in your note, you described the earnings report as a solid quarter that should be rewarded, but also that expectations were high heading into this print. In what specific areas did Coca-Cola perhaps fall short of impressing? Was it the organic sales number, the outlook not being raised and just merely maintained?
Yeah, thanks for having me. I think if you look at Coke's quarter, across the board, relatively solid. You're talking about a record operating margin that the company printed in the quarter, and that goes back, again, in our model, almost 20 years, as well as an organic sales print that was very solid. I think the one area where investors are picking at today a bit is really on the unit case volume side. Unit cases in Coke's model are consumption metrics, so really from a global perspective, maybe a touch light of where expectations were, but still overall a very solid quarter.
And Peter, I was taking a look at the transcript of the earnings call. It seems like you were the lone voice asking about Europe. on the earnings call. So what does the mood music look like there, especially when you compare the U.S. market to what we're seeing overseas?
Yeah, it was interesting that we got all the way to my question and nobody had brought it up yet. Look, I think if you look at Europe so far through the first half of the year, across our consumer staples coverage, and this has been the case in food and household personal care and beverages as well, it's the first time in a long time that Europe has really outperformed the U.S. Maybe a bit more of a resilient consumer there, at least at this point, whereas in the U.S. we've seen a bit more of a degradation in some of the lower income cohorts.
We know for the U.S. market, Coca-Cola released plans to launch this new Coke product made with cane sugar in the fall. How big of a deal is this on the cost side, Peter?
So I think if you look at, and this is based on the last report, kind of cane sugar relative to high fructose corn syrup, it's about a 65% difference in terms of the actual price. Look, this is a supplemental product that Coke is launching. It is not going to be a full-on replacement for kind of the classic, Coke Red can. It'll be a supplemental product for consumers out there, and I know that the president tweeted about this as well, who are looking for, a cane sugar-based Coke.
Yeah, it does. There's a lot to say about the political environment and extrapolating out this move for U.S. sugarcane products from Coke. But I actually want to talk a little bit about the competitive landscape there. I know that you also have Pepsi in your coverage area, I believe. And you take a look at Pepsi versus Coke over the past 5 years or so. Coke is the clear winner, up about 70% on a total return basis versus a pedestrian 24% for Pepsi. Do you continue to expect that to be the dynamic going forward, that you have one clear leader in this duopoly?
Look, I think when we talk about Pepsi, there's a bit of a different dynamic with so much of the value in the company actually being driven by the food side relative to the beverage side. So remember just that Pepsi owns Frito-Lay. That business has struggled really over the past kind of 18 months as the salty snacks category has struggled. Whereas Coke, again, being much more focused on carbonated soft drinks and beverages in general, has given them probably a leg up. I think the other piece on Coke, just to remember, much more international exposure relative to Pepsi. About 80% of Coke's profits come from outside of the U.S. And so, again, as emerging markets have been a bit more of a growth driver, that's helped Coke kind of outperform Pepsi.
Going forward, what do you want to hear from the company to really drive the growth narrative from, for the next foreseeable couple of months?
Yeah, I think as it relates to Coke, it's really just a continued focus. They're executing at a very high level on this kind of all-weather strategy. And there's really no holes in the portfolio in terms of what they're offering. So Coke offers you a zero-sugar product. They can offer you a protein-enriched product, waters that are fortified with certain minerals and other elements. They even have a special relationship with Monster globally that offers energy drinks. So it's really a total beverage strategy. And so again, it's just really just continuing to execute at a high level and being where the consumer is going at all times.
All right, Peter, great to get some time with you. Our thanks to Peter Galbo. He is Senior Consumer Products Analyst over at Bank of America Securities. Now up next, the biggest U.S. banks descending on the Fed's first-of-its-kind regulatory conference. We'll bring you the latest live from the Fed next. This is The Close.
We need our large banks to be well capitalized and to manage their key risks well. And we need large banks to be free to compete with one another, with non-bank financial institutions and with banks in other jurisdictions to provide capital and support economic growth.
And that was Fed Chair Jerome Powell calling for better efficiency in the U.S. financial system today at a first-of-its-kind conference set up to review large banks' capital frameworks. J.P. Morgan, Goldman Sachs, and Morgan Stanley officials all hoping to sway regulators in their favor and away from tighter capital restrictions. For more, let's bring in Bloomberg's Katanga Johnson, who joins us live from just outside the conference. As I mentioned, this is the first of its kind. So bring us into some of the conversations that have been underway in Washington, Katanga.
Yeah, the Fed opened its doors today to a host of bank executives and academics, advocates as well, to really talk about what the right requirements are for capital. it was also a focus to ensure that not just capital requirements, but making sure that rules are tailored to banks of different size. That is, that the biggest banks carry the brunt of the weight tied to requirements, and smaller banks can be more competitive. And ultimately, regulators envision a scenario where smaller banks can perhaps have tie-ups with fintechs and crypto companies to be more competitive. And the vision, the goal of getting capital requirements and rules right based on banks and their size is really to ensure that in this economic environment, regulators want to see more lending, want to see more small businesses, sort of get a slice in the action. And this is all, of course, with the backdrop of tariffs being a heated discussion. But today, inside the Fed, the focus was on what does it take to make the banking landscape and the small business landscape more competitive.
Okay, so it's clearly a dialogue here between the industry and its regulators. Having said that, when are people actually expecting action on some of these rule changes or easing of rules?
Yeah, the outcomes of the conference today are yet to be seen. The Fed has already taken action before this conference to discuss its enhanced supplementary leverage ratio. That's one of 4 different capital requirements. They also be looking at risk-based capital tied to the Basel III endgame, as well as surcharge for the largest banks. These requirements really are meant to work in tandem. Regulators do want to repropose rules that, under the Biden administration, that the industry considered too onerous. But as Powell and Bowman have said, capital in the system is about right. They're not necessarily looking to just lower capital across the board, but they do want to see how rules interact with each other and get to the right balance of capital requirements for these lenders.
And so it feels like these big banks, they have a lot to celebrate right now. You think about some of the SLR changes that you've been reporting on. That has been a big win. And just in general, I mean, talk us through the environment, because it seems like, at least looking at the stock performance, a lot of things have been aligning for these big lenders.
It's clear that banks walked into this conference today, for those that were represented, and the industry and their lobbyists really sort of with the upper hand. The direction of travel for rules does seem to be either more neutral or lower, and banks are hoping that if regulators can fine-tune the remaining or pending regulations tied to capital, then they can, of course, reward their shareholders well, but also support the administration's efforts to boost lending. At least that's been a lot of the conversation today. We'll have to see what comes of the rules and how the banks respond.
Yeah.
Of course, there has been criticism before this event and by some academics inside that if you loosen rules too much, will banks actually respond favorably?
All right, Katanga, really appreciate you joining us. Bloomberg's Katanga Johnson covering financial regulation for us in Washington. Next up, we've got Marc Rosen of Catalyst Brands. This is The Close. It is just about 3:30 here in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Katie Greifeld, and I'm so thrilled to be anchoring today when we're back in 2021 and talking about meme stocks, because holy moly, let's take a look at Kohl's on the day.
Wait, is this a new meme stock?
I think so. I mean, unless you have a fundamental reason for whatever that chart is.
It's a 39% jump over one day.
Just amazing, because at one point today, it was higher by as much as 105%. It was halted for volatility at least once. And I mean, people have been rooting around for a reason. Maybe it's a short squeeze when you consider how much of the float is shorted right now. But it looks memey, especially when you pair it together with what's happening in Open Door, for example.
Absolutely, about 300% over the past 7 days. I'm just looking at the short interest in Kohl's, about 49%. So just under half of the float is shorted right now.
Exactly, a lot of eyes on this retailer, and we'll continue to follow that. But let's talk actually about the business of retailing and the broader retail sector. We'll do that with Marc Rosen. He is the CEO of Catalyst Brands. That is the parent company of JCPenney, Nautica, and others. And Marc, it's great to have you with us.
Thank you for having me.
I won't ask you to explain what's happening with Kohl's, but I want to talk about some of the brands that you have under your management, because tariffs are the talk of the town. And you think about retailers getting hit really on both sides here. You have consumer demand and you also have raw input costs. So what are you seeing when you look at some of your portfolio companies?
Yeah, it's interesting. So as we're looking at the environment right now, as you mentioned, there's certainly, there is a lot of uncertainty out there around both tariffs and the economy right now. But I think one thing that we know for sure, and we're seeing it as we're looking at the consumer and shopping patterns and trends right now, is that the customer is going into back to school and they're going back into fall. And we know that they are going to be focused on getting their family ready for back to school. We're there across our brands. You mentioned JCPenney, but across JCPenney, across Eddie Bauer, Lucky, Nautica, Aeropostale, and Brooks Brothers. Across that portfolio, we're focused on bringing them fashion, on bringing them style, on bringing them quality that's better than they expected at a price that is accessible to them. And so we're really focused on, for back to school, making sure that we are coming in with the customer for pre-tariff pricing on the items that they're focused on. So think about uniforms, right? Every kid going back to school, they need uniforms, they need denim, they need jeans, they need t-shirts, they need backpacks, and we're going to be offering pre-tariff pricing on all of those items.
Let's talk about what that means, pre-tariff pricing. Does that take us to this time last year, or what is the benchmark that you're using there?
Yeah, our benchmark is the pricing that we had for back to school last year. So on those items, we will be offering the same pricing that we had last year, and we know that's really important to consumers as they're looking more than ever with everything that's going on in the economy for value, but they're also looking for great quality. I think one of the other things that we're going to be doing, which exactly as you said, will be at the exact same pricing as last year, and it's something unexpected people don't know we offer at JCPenney, is kids cuts for back to school. So, right, they need the jeans, they need the t-shirt, but mom also wants them to have the haircut. And we're going to give over 100,000 haircuts at $12, which is same pricing as last year.
That's a bargain, just thinking aloud, and that's really thinking from a parent and a customer's perspective as well. You talk about customer behavior. The announcement of tariffs really trained companies and consumers alike to front load their purchases to get ahead of price increases. Do you see that kind of behavior sticking around?
So I think our consumer has really been focused on taking care of their family and taking care of their needs. So we didn't see a lot of forward buying or front loading in the categories that we sell. So across apparel and things like that. I think it's probably true in some of the bigger ticket items and things like that.
Okay.
But what we're seeing right now is consumers are focused on what they need right now and buy now, wear now.
What role do Vietnam, Indonesia, and the Philippines play in your global supply chain? I ask because these are the countries that have so far signed bilateral trade deals with the U.S.
Right. So, our sourcing, if you look at our sourcing base, we're spread across a large number of countries of origin, and we really are, we're the buying agents for our customers. So it's part of our responsibility, and this is one of the advantages of the combination of Catalyst and of all of our brands coming together, is that we can take the volume that we buy. So if you think about denim, for example, which we were talking about for back to school, if you think about Lucky brand, if you think about Aeropostale, and then take JCPenney and brands like Arizona and Mutual Weave and A&A, the amount of denim that we buy across that whole portfolio, what our sourcing teams and buyers do is go out and look at what's the best place to source that, and how do we make sure we're doing that in a way that we can get the best price for the consumer, inclusive of what we're facing in the tariff environment right now.
Fashion is so fickle, though. I mean, denim, it's a classic. It's probably always going to be popular for back to school. But you think about some of the different trends. I think the barrel jeans were popular for like a hot minute.
I thought they still were, but I'm out of it.
I don't know. I'm just following what TikTok tells me. But how do you keep abreast of some of those shifting fashion trends, which, again, can be pretty fickle?
They can, and right now, baggy and relaxed is what is back right now.
No skinny jeans.
So no, absolutely not, right? Baggy and relaxed is a trend, and that's what kids are looking for. And again, whether you go to Aeropostale, if you go to JCPenney and look at our Arizona brand or our kids brands, that's what we're going to have. But that's the job of our merchants, is to really be out there and understand the trends, understand what customers want, and make sure that we have the things that kids are going to be happy going back to school in, and even for adults right now, we're talking about back to school, but fall is also a time when across the family, everybody's freshening the wardrobe.
Yeah, it's funny. When you mentioned the baggy silhouette, that was cited as a risk factor for Lululemon once upon a time, which is pretty funny. But I mean, you think about what you were mentioning, that we're talking about kids, we're talking about back to school, but you're talking about adults as well. I still come back to consumer sentiment here, and I hear what you're saying. I mean, you need back to school clothes, but are you seeing any sort of pullback when you look across your portfolio of brands on some of the more discretionary items there?
I think the encouraging thing that we're seeing is where customers see value, they're shopping right now. And I think value is driving a lot of their purchasing decisions more. Again, I think that's the power of the combination of Catalyst is when you look across all of our brands, we're focused on making sure the customer has the latest style and they have the best fashion, but we're also focused on being priced in an accessible way. And I think that's what the customer's looking more for right now. So we're seeing, positive comp store sales trends, very strong in our Aeropostale business. Again, they're finding great value there. In our Brooks Brothers business, again, not a back to school, but that's a back to fall and back to work. We're seeing really strong positive comps there. And we're also seeing positive customer growth and customer traffic growth. We were up 6% last quarter in the JCPenney business. So I think customers are seeking value more right now, given what's going on in the economic environment, and that's what we're here to give them.
You mentioned Aeropostale. Abercrombie & Fitch, of course, reinvented itself from a teen retailer into a specialty retailer catering to young professionals. And given that Aeropostale was often mentioned in the same breath as Abercrombie & Fitch, do you see targeting a more specific demographic like the way Abercrombie & Fitch did as a path forward for Aeropostale?
Look, Aeropostale is really focused on what we would call like the 13 to 18-year-old. So I would call it that middle school and that high school student. And so again, I think that move has created a lot of space for the Aeropostale business, and we're seeing really positive growth because of that. One of the things that we just launched in Aeropostale is with an influencer that you would see across TikTok and Instagram, Demetra, who was actually an intern in our business. She just designed an apparel line. We launched it on the app, and we've had amazing results. So I think that customer and that age group is, they're looking across social and they're finding great fashion trends and they're finding great value. And
it's very organic, not to mention as well.
Absolutely.
All right, Marc Rosen, really appreciate your joining us today. Marc Rosen is CEO of Catalyst Brands, which owns, among other brands, JCPenney, Aeropostale, and Brooks Brothers.
Thank you for having me.
Coming up, a defiant move higher for D.R. Horton after the home builder cut its full-year forecast. We'll discuss why D.R. Horton is up almost 17% in our Stock of the Hour next. This is The Close on Bloomberg. All right, today's Stock of the Hour is D.R. Horton, ticker DHI. The shares headed for their best day since March 2009 after reporting earnings. However, the home builder beating estimates, but trimming the full-year forecast, or at least the high end of its full-year sales forecast. Norah Mulinda of Bloomberg News joins us now. So people overlooked the forecast and sent the stock higher because of what had happened?
Yeah, I mean, we're seeing shares going higher, as you already mentioned, and we are seeing D.R. Horton really just seeing all the other stocks coming behind it. We're seeing a broad-based rally here, and that's after D.R. Horton reported orders that topped estimates. So that's what's people are really looking at right now here. But we do have analysts that are also pointing toward gross margin as potentially being a problem area, or just an area that people are really focused on, which tends to be a key metric here for the industry more broadly.
It's so funny because we were just having the conversation with Liz and Sonders about how companies were being punished. That story falls apart talking about D.R. Horton, but give us a lay of the land here when it comes to the profile of D.R. Horton and the types of homes that they're building and how we might extrapolate that out to some of the other home builders that still have yet to report.
Yes, D.R. Horton, it focuses on both entry-level buyers and move-up buyers. So move-up buyers are people who are upgrading into a new home. They've been in their home for a little while and they're ready to move on to something else. So those are their target areas, but of course they do kind of cater to a swath of demographics when it comes to what types of buyers that they work with. But this is really great news for the company. And of course, as you mentioned, the broader sector here, I'm seeing S15 Home, which is an index that tracks a lot of home builders. It's seeing its best day since 2022. So we are seeing a rally up 10% here. But it's interesting because when I think about, the average millennial or the person who's looking to buy a home right now, I don't hear too many people closing. So it's interesting that they're actually, we are seeing an uptick here. We are seeing people actually going to buy new homes as opposed to some of those used homes that are also out there on the market here.
Well, that raises an interesting question. What kind of incentives are they offering in order to get those orders? Are they still doing a lot of buy downs?
And that has been a concern for investors. It's really been watching D.R. Horton because they continue to do these incentives and they expect to continue to do that moving forward as well. But of course, when you're thinking about a market where you really need to lure people in with prices so high and rates so so high as well, people are really looking to these new home builders to bring them a reason to go and buy a home. And for them, that tends to be buying down rates maybe a percentage point lower than what the market is offering, or, you know, throwing in some different amenities that make it feel like it's worth the while.
A marble countertop.
Yeah, absolutely.
Maybe a new fridge.
I want 2 sinks in the master bathroom. That's what I want. Maybe it's not going to happen, though, because D.R. Horton did note on their call that they see a future that has smaller homes. They said that square footage has declined consistently over the last 2 years, and they expect that trend to continue.
Wow.
Yeah.
I mean, I think that it's interesting, especially when you compare D.R. Horton to the likes of some of its competitors like Toll Brothers. They tend to cater to a lot of those luxury, higher end buyers. And of course, when you think about people maybe ultra high net worth or people who are just making more, they have more room to spend here, especially if you think about a second home being a discretionary item, whereas some people may see their first entry level home being a necessity. So you do see a difference in performance here in some aspects in terms of different markets across the nation.
Absolutely. And just again, D.R. Horton shares up about 17%, the biggest move now since March of 2020. Norah, Mulinda, great reporting. As always, they're tracking all of the home builders. And coming up, we're going to count you down to the closing bells. We're just about 15 minutes or so away. We'll do that with Meb Faber. He's the co-founder and CIO of Cambria Investment Management. Not a conversation that you want to miss. That's up next. This is The Close on Bloomberg.
Welcome back to The Close. We're roughly 10 minutes away from the closing bells, and we are looking at record highs here for the S&P 500 and the NASDAQ.
Just slightly,
well,
though,
not the
right?
NASDAQ, sorry. That's come down, but yeah, just
slightly.
Yeah,
that's going the other way. And it's trying to drag down the S&P 500 to those big tech names. But as you said, could close at a record if we just stay this color. The S&P 500 up by about 0.1%. The NASDAQ 100, a different story. The small caps out in charge. They've been the underperformer year to date, but at least for one day, they're a winner. The Russell 2000 up almost 1%. And the bond market, you've really seen this bid come into the long end, which is a bit of a head scratcher for some.
Absolutely, because everyone was saying they want to avoid the long end. They want to be in the short end, but we're seeing a little bit of outperformance in the long end today. All right, let's bring in now Meb Faber. He is co-founder and CIO at Cambria Asset or Investment Management. And Meb, so good to speak with you. I know that you are of the view that U.S. stocks are expensive. Certainly the big cap names are. But what do you think about the small cap names? Because as Katie mentioned, they've been laggards for so long versus the big caps. There's bound to be a lot of value tied up in those small cap names.
Yeah, we think so. I mean, look, U.S. stock market's expensive, no question. We're with a spitting distance of taking out the valuation highs of 2021, which was a crazy time. So really all that's left is the final boss, right? December 1999, hit a CAPE ratio almost 45 on the PE. But like you mentioned, very similar to the late 90s, small caps have just not kept up. They've underperformed for so long, it feels like talking to anybody about them, it's like talking about foreign stocks, emerging market stocks. It's like you hit a funny bone. They don't want to talk about it. But we see a lot of valuation opportunity. We think the indices, maybe not so much across the board on small cap. You want to look toward value, towards quality, a lot of opportunity, a lot of overlapping circles with other things, not just small caps, but value, ex-US too. Small caps look great.
All right, so when you look at earnings, and I know that a lot of this will kind of justify your take on where valuations are, what are you looking for to determine whether we're going to get a retreat in some of the share prices from these nosebleed highs?
If you look at a topic like valuation, everyone wants to group it into all just one big thing. Is value working? Is value not working? But there's times where it works in some places and times where it works less well. And this year in particular, where it's really working is ex-US. So foreign and emerging, everyone knows it's outperforming this year. Part of that, you're getting that big dollar down tailwind. But the deep value stuff, ex-US, is up well over 30%. Some of these countries, like Poland, is up like 60%. And not a lot of people are talking about it. You're starting to hear the sentiment shift a little bit. You're starting to see the behavior change just a little bit. But every quarter, when people start to open their statements and say, my goodness, all of a sudden, Europe is just face ripper. Yeah, it's cool the US is up a little bit. But really, this massive change of 15 years of underperformance, I think you're going to start to see the flows really start to push this story Q3, Q4, and on into 26. Will small caps in the U.S. catch a bid too? We'll see if they get grouped into the rest of this value trade. But for right now, it's been mostly an ex-US story.
Well, Meb, you seem really eager to talk about that ex-US story, so let's stay there because, I mean, this is a question I could have asked in January, February, March, the list goes on, at any point this year. How sustainable is this European and rest of world outperformance? Because I think the reason why you haven't seen flows kind of chase this rally is because we've been here before and we've seen plenty of false dawns.
If you look at the US and the concentration, everyone talks about this. Everyone knows about NVIDIA, right? Here's a fun stat for you. In our global value ETF, this is GVAL, it owns 12 countries. The 12 most hated, cheapest, forgotten about things like Turkey and Poland, Czech Republic, on, even the UK. It owns these countries. It has about the same market cap weight as NVIDIA. All 12 countries, you get one stock in the US. And it's not just NVIDIA, you know, you're talking about 4 trillion. You could add up the Apples and the Microsofts of the world too. But you get such a massive concentration, and maybe somebody listening that says, well, fine, I just want NVIDIA. But I would much rather have a diversified exposure to all these forgotten countries around the world that over time and historically, there is no valuation premium in the US. Versus ex-US. It just happens to be, there has been for the last 15 years.
Well, Meb, you stole my pushback that a lot of people would say, okay, well, I just want NVIDIA. And you talk about these forgotten countries, and I feel like they've been forgotten because the US tech industry is just so dominant, and you see that in the stock market and on the world stage as well. So if this rest of world outperformance is going to continue, if Europe is going to continue to shine, what is the fundamental driver there that will continue that rally?
Let me give you a solution. A lot of people feel stuck. Now, if they've listened to your podcast or if they read Bloomberg in print this week, they would know that if you have these highly appreciated securities, everyone says, look, I got NVIDIA, I got cost basis of $1, I can't do anything with it. Taxman's gonna kill me. But we now have the ability to shift your portfolios in the 351 ETF exchanges into the seeding of an ETF and be able to get out of these highly appreciated stocks, concentrated portfolios. Even though we've talked about it a few times here, nobody's heard about it. So I think there's a lot of people out there that do want to shift. They want to rebalance their portfolio away from the NASDAQ, Mag 7, expensive stocks into the things that are like value, quality, shareholder yield, ex-US. I mean, if you had a 60-40 portfolio in 2009, you're sitting on 90-10 today. You're terribly offside. And for a long time, there hasn't been that many good solutions. 350 ETF exchanges, we've said, we think it's a bigger deal than crypto ETFs. You're slowly starting to see the acceptance this year. We've got a couple more planned. 2026, I think, will be the big widespread adoption. But it's one more solution for people that, you know, are thinking about taxes and what to do with their portfolios that feel stuck.
So it's a solution, and I hear you on valuations, high U.S. valuations versus low rest of the world valuations. But if investors want exposure to technology, cutting edge technology that can mostly be found in the U.S., they need that exposure to the U.S. big cap tech stocks. So where does that leave them in terms of not chasing value, but seeking out value globally? How much of your portfolio should that comprise?
You got to remember, U.S. is darn near 2/3 of world market cap. Now, as a percentage of global GDP, U.S. is only a quarter. Now, you ask most people that, and they usually get it wrong. If you ask most people about emerging markets are a majority of world GDP. Now, as far as market cap, it's only like 10%. As far as population, it's well north of 80%. And so getting exposure, particularly in emerging markets, you know, we have an EYLD shareholder yield fund, and it surprises people because when they hear value, they think, Meb, you're old, fuddy-duddy, you're going to avoid all the tech stocks. And we say that's true often in the U.S. It's not true in emerging. Emerging markets, tech is our second largest allocation.
All right, got it. Meb Faber is co-founder and CIO at Cambria Investment Management, making the case for investing in the forgotten rest of world stocks, particularly in the value sector, which really has lost a lot of ground to growth.
Value International, I mean, I know it's outperforming, but you need a strong stomach.
You absolutely do. We're moving you closer to the closing bell. Full market coverage begins right here on Bloomberg Television.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We are about 2 minutes away from the end of the trading day on this Tuesday. Scarlett Fu and Katie Greifeld here with you to take you through the closing bell. We've got a global simulcast. We're joined now by Carol Massar and Tim Stenovic, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide as we parse through the most crucial moments of this trading day. And Carol, I feel like the crucial moments are we're waiting until Wednesday when two big cap tech names report.
I think you've said it so well. I mean, we've been bouncing around here, and we've got kind of little changes on both the S&P, some big tech under pressure. Want some outperformance, folks, though? Look at the home builders. That as a whole up about 10% if you look at the S&P Composite 1500 home building index. And, you know, that has D.R. Horton and Pulte to thank because some of their numbers coming in and beating Wall Street expectations.
A couple of those would be good gainers. I don't know what you have on tap, Carol, but those are a couple of good ones if it's not too late. You know, I'm thinking we got Coca-Cola, we got Lockheed Martin, we got General Motors, but like Scarlett said, we haven't gotten the big ones yet. We are starting to see a picture emerge, though, of what companies are dealing with when it comes to tariffs and what they're thinking about when it comes to the American consumer. And I guess it turns out, Katie, we want sugar in our Coca-Cola.
Yeah, surprise, specifically U.S. cane sugar, apparently. And we were talking about it, how it's really a political statement, but that kind of feels like what companies have to do in this environment. Yeah, that's kind of appropriate for the moment in any case. As we look at this market, there's this resilience to equities that it kind of surprises me time and again, even with all the uncertainty regarding trade policy, tariffs, and even the fate of the Federal Reserve Chair. There you have the closing bells. We are looking at record highs here for the S&P 500, even as it's given up a little bit of its rally here towards the end. Looks like it's going to close up about 0.1%, finishing above 63.10, maybe, almost. There you go. Well,
almost there.
Not quite.
Not quite. All right. The Nasdaq down about 0.4%. And the weak link there is some of those big cap tech names before Alphabet and Tesla report on Wednesday. And Dow Jones Industrial Average adding 0.4% to 44,502. And the Russell 2000, actually the outperformer of the day. And Katie, you and I were talking about this. We've seen the small caps kind of get a little bit of a tailwind the last month or so, but for so long, they've been perennial laggards when you compare them to big caps over the longer term, anything past 6 months.
Just like Europe, which is amazing. But at least for today, small caps in the sun, Carol Masser.
All right, Katie Greifeld, S&P 500, back to the big caps we go. And man, do I have this right? Because I feel like the split has been all over the place, but we're ending with about 407 names to the upside in the S&P 500. Katie, just 95 to the downside.
No, you're right that it
wasn't like that before.
Exactly.
A little while ago.
We have really good breadth today, even though you wouldn't necessarily know it by looking at the percent change on the S&P 500. But when it comes to the sector change today, you had 9 of 11 sectors in the green, led by healthcare, actually, on a points basis. But it was big tech on the downside.
Well, speaking of big tech, we have a smaller big company from the tech space reporting. Texas Instruments coming out with second quarter EPS of $1.41, beating the consensus estimate of $1.35. Revenue for the quarter was $4.45 billion, also higher than anticipated, which was $4.36 billion. As for the outlook, it sees revenue for this quarter between $4.45 billion to $4.80 billion. Analysts were looking for $4.57 billion, so the midpoint of that range handily beating the consensus estimate. Third quarter EPS will be anywhere from $1.36 to $1.60. Analysts were looking for $1.50. And second quarter CapEx, now I'm going backwards here, was $1.31 billion, more than expected. Analysts were looking for $1.17 billion. And you can see right now the stock, Tim, down about 7% in after-hours trading.
Yeah, there's no commentary from executives in the press release. Going to have to wait to get that from the earnings call, but worth reiterating that revenue increased 9% sequentially. It was led by continued brand recovery in industrial, 16% from the same quarter a year ago. The company also saying that over the past 12 months, they've invested $3.9 billion in R&D and SG&A and invested $4.9 billion in CapEx and returned $6.7 billion to owners.
All right, so just a reminder here, folks, you are seeing a lot of selling in Texas Instruments in the aftermarket, down about 8%. There was some concern and nervousness heading into this report because they felt like the outlook, a lack of visibility, and any obvious growth catalyst might put some pressure on this name. But is the street not liking it. And you got to keep in mind the stock is up about 15% year to date, but definitely some disappointment here in the aftermarket, Katie.
Yeah, that outperformance might be a reason why you're seeing this after hours reaction right now, which looks pretty dramatic. Like you said, down 8%. Now, of course, their third quarter outlook didn't include changes to U.S. tax legislation, so maybe that explains some of the negativity here. But we've been talking all program about how a lot of these companies, the bar is really high, at least when it comes to sentiment, and these misses, if there's anything to pick at, are getting punished, Carol.
Yeah, and I would say, I just want to throw one more thing in, and maybe the disappointment has to do with the third quarter outlook, right? It's seeing third quarter EPS of $1.36 to $1.60. The estimate is $1.50. It sees third quarter revenue from $4.45 billion to $4.8 billion. The estimate is $4.57 billion. So there's a bit of a range and definitely some room for disappointment. So maybe that has to do with some of the selling that we're seeing here in the aftermarket. We'll keep a watch on it, but right now shares of Texas Instruments still down about 7%. Hey, just a quick summary of some of the stocks that were on the move in the regular session. We talked about home builders, outperformance there. Here's the reasons why. D.R. Horton was up about 16% here at the close today, a top gainer in the S&P. The third quarter earnings beat expectations. Profit orders and home closings beating analyst estimates. Go to Pulte Group, also out with their results. That stock was up 12% at the close. Again, a top gainer in the S&P. They reported better than expected earnings. So that was a big one. And we got some more earnings crossing.
Yeah, looking at Intuitive Surgical, pulling it up on the Bloomberg terminal, seeing shares in the after hours, not necessarily on the move. Intuitive Surgical second quarter revenue coming in at $2.44 billion. Estimates were for $2.35 billion. Second quarter adjusted earnings per share coming in at way above estimates at $2.2 billion. The estimate was for $1.93. Shares now on the move, higher by 5.7%.
Yeah, starting to see some reaction there after second quarter adjusted EPS beat its estimates. And this is a name that needed some good news, Tim. You consider the fact that Intuitive Surgical shares were down about 2% heading into today's close and these numbers.
All right, we have most of the big banks done reporting, but we have a financial company that has just reported, and that is Capital One. Let's give you the second quarter adjusted EPS number, $5.48. Far away beating the consensus estimate of $3.88. So maybe we're not comparing like with like. Let's look at the net revenue line, $12.49 billion, also higher than the expected $11.84 billion. Net interest margin for the period was 7.62%, better than the 7.43%. As for loans held for investment, that came out to about $439.3 billion. Analysts were looking for about $397 billion. And one comment from Capital One, the integration of Discover is going well. So we're looking for more commentary, of course, on that. Second quarter provision for credit losses was about $11.43 billion. The consensus estimate, if this is the right comparison, is $3.88 billion. That seems a little bit off, but we'll dig into that a little bit more. The stock is now lower in after-hours trading.
All right, here's one that is definitely rallying in the aftermarket, although it's having a pretty miserable 2025. We're talking about Enphase Energy. It's up almost 6% here in the aftermarket. Keep in mind, it's off about 37% year to date, the solar energy company. And let's go through some of the numbers. Second quarter adjusted EPS, that's a beat, 6 cents better than what the street was expecting, 69 versus the estimate of 63. Second quarter revenue, that came in better than forecast, $363.2 million. The estimate was $359.3, and then this is what matters, perhaps. The third quarter revenue outlook, $330 million to $370 million. It's quite a gap. The estimate is for $371.9 million. But again, this stock, Katie, is up about 8% in the aftermarket.
Yeah, it's wild. Well, you mentioned that it's having a miserable 2025. So just to put some context to that, shares down about 38% on a total return basis into the close. We know that Enphase and some of the other clean energies, some of the other solar names have been really whipsawed by policy coming out of the White House. So I guess the fact that they were able to report good news on any level, you can see the shares really taking off after hours.
Yeah, speaking of whipsawing, I'm watching shares of Intuitive Surgical. At first, they did move higher. Now they're down 4.5% in the after hours. The company did say, remember, this is the company that has the Da Vinci surgical robot. It's that high precision robot that does surgery on many different parts of the human body. They did say that procedures grew at approximately 17% in the second quarter of 2024. And now they grew their Da Vinci surgical system installed base to 10,488 systems as of the end of the quarter in June 2025. That's an increase of 14% compared to June 30th, 2024.
And just real quickly, analog devices and on-semi both down in sympathy, I guess, with Texas Instruments, which is still down about 6.8%. So we're seeing some impact on some of the other chip names. All right, guys, that's a wrap across platform, radio, TV, YouTube, Bloomberg Originals. We do it all across all of our platforms. We will see you again, same time, same place tomorrow.
And of course, coming up, we've got a conversation with Deputy Treasury Secretary Michael Faulkender. Stick with us as we talk about the Fed and the Trump administration's economic priorities. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Katie Greifeld. Let's take a look at where markets closed out the day on this Tuesday. A record high for the S&P 500, though kind of an uninspired move higher on the index, less than 0.1% there. But still, that counts. Even though big tech tried to drag us down, you can see the NASDAQ 100 falling about 0.5% ahead of some pretty key earnings reports tomorrow. The bright spot, the shining star, was your small caps, the Russell 2000 index, rising about 0.8%. We were closer to 1% gains earlier in the session, but we'll take it. And that 10-year Treasury yield falling another 3.5 basis points. Again, we just continue to move lower here, which is a bit interesting, Scarlett. Of course, there's been a lot of focus on the long end of the Treasury curve with all of the conversation around the Federal Reserve.
Absolutely. And of course, the Fed Chair Jay Powell is under pressure once again. Here's what President Trump had to say earlier today.
I think he's done a bad job, but he's going to be out pretty soon anyway. In eight months, he'll be out. But I call him too late. He's too late all the time. He should have lowered interest rates many times. Europe lowered their rate 10 times. We lowered ours none. And it's causing a problem for people that want to buy a home.
Joining us now to discuss is Michael Faulkender. He is Deputy Treasury Secretary, and he joins us now from the White House. Michael, thank you so much for speaking with us. The president has consistently called Jay Powell not a great Fed chair, saying that he's done a bad job. What exactly about the job that Jay Powell has done is not up to measure? The labor market is holding up well. Inflation has not reared its ugly head. I mean, it's above the 2% target, but it hasn't blown up just yet. Where do you see the economy failing under Jay Powell's leadership?
It's great to be with you. Yeah, if you look at Jay Powell's tenure, I mean, we do have to remember that it was under his watch that we saw 40-year high inflation. They were way too late to recognizing the inherently inflationary impact of the Biden administration's economic policy. They waited too long to start raising interest rates to offset some of the inflationary pressure that was going to create. And then juxtapose that to now, where we're putting in place supply side benefits to the economy through the president's signing of the One Big Beautiful Bill a couple of weeks ago. All of the deregulatory activity we're engaged in. We see the inflation numbers coming in below expectations. And yet, as the president said, we have not seen the Fed come in and commensurately cut rates. And now we've got one of the highest interest rates compared to our peer nations. So he was too late to raise rates when the Biden administration's economic policies were inherently inflationary. And he's been too slow to cut rates now that we are putting in place supply side economic policies that should be bringing down price pressures.
And of course, Scott Bessent, the Treasury Secretary, has weighed in as well, saying that there's nothing he sees that indicates Jay Powell should step down right now. But he also added that if Powell wants to see that through, he wants to see through his term, he should be able to do that. And if he wants to leave, he should as well. How do you interpret that? I had trouble understanding what he was saying there.
I mean, ultimately, it is the decision of the Federal Reserve Chairman as to whether or not he steps down or not. But I think the most important thing that the Secretary called for is that the Fed really should undertake a review of its practices. So it engages regularly in a monetary policy review, but the Fed's mission creep has extended beyond monetary policy, and there has not been a review of the extent to which they have succeeded or failed at some of the other activities that they are responsible for. And so if you look at the bank failures that we had over the last couple of years, where was the Fed in terms of its supervisory activity? We have got this building that's being built, and we've got thousands of economists over there, and it's questionable what it is, what service the American people is realizing from them. And so I think what the Secretary has come out and said is that there are 8 months left in his chairmanship. If he wants to serve it out, president has said he can do so, but that does not absolve the chairman from doing a full review of what has happened under his watch to make sure that we're reviewing whether the Fed is appropriately stewarding their portion of this economy.
Let's talk just firmly about monetary policy and what you believe should happen there, because I believe just today alone, President Donald Trump said that he thinks that interest rates should be at 1%. You take a look at the effective Fed fund rate right now, it's at 4.33%. So that would certainly be a dramatic move. And when you take a look at the state of this economy, where we stand, I mean, do you think, in your opinion, does 1% look reasonable from where you're sitting?
When I look at the data out there and the progress that this administration is making to relax any inflationary pressures, it seems like the interest rate environment that the Fed has should be reevaluated and come down significantly. Now, again, I'm not going to say, I'm not a member of the Federal Reserve, so I'm not going to say where interest rates ought to be. But if you look at the data, inflation is coming in below expectations. We recently hit a 4-year low on inflation. We're putting in place certainty on taxes. We are deregulating the economy. We are signing great trade deals. We had 2 of them announced today. And so the president's full implementation of the president's economic plan is inherently disinflationary, and yet the Fed keeps rates at the high levels that they're at. Arguably, there is enormous room for the Fed to come in and cut rates.
Well, we have that next Fed meeting coming up just 8 days from now, next Wednesday. I don't think the market is anticipating a rate cut there, but crazier things have happened. I do want to talk a little bit about trade, because Treasury Secretary Bessent, of course, is meeting his Chinese counterparts in Sweden next week. What are the expectations for those talks? What would you expect to be discussed there?
I anticipate that the Secretary is going to continue to make progress on the terms of a final deal. So there is continuing discussion about access to markets, about opening up the Chinese markets, issues associated with their activities on rare earths and the export controls that they have put in, and of course also the ultimate tariff rate. So there is enormous space for us to talk about what for decades has been practices by the Chinese government that give them unfair advantages in the global marketplace, and that this president in his first term said that we are going to finally address. And I anticipate that the Secretary is going to make significant progress when he meets with his counterpart next week in order to have discussions about getting towards a final deal.
The Treasury Secretary also said that the discussion may broaden out to Chinese purchases of Russian and Iranian oil as well. What sense do you have that Beijing is ready to discuss those issues with Washington?
I mean, as you know, the president has said that the war in Ukraine never should have started, that we need to put pressure on the Russians in order to bring an end to that. And that means upping our pressure, using our sanctions authority and our conversations with our international partners to reduce the flow of funds that are going into Russia. Simultaneously, we are still looking for the Iranians to curtail and end their nuclear weapons program. And in that case, we are going to continue applying maximum pressure on them. And in both cases, it largely is China that is purchasing sanctioned oil from the Iranians and the Russians. And so we are continuing to ask the Chinese to do their part to see that those countries not be able to fund their aggression through these oil sales that the Chinese are purchasing.
And what is the worry that if you press Beijing too hard, that China will begin withholding exports of those rare earth magnets and other crucial raw materials as they've done in the past? They could slow walk it again, because that's a big issue and it's finally starting to come through again.
I think what the Secretary is going to do is just have a comprehensive discussion about all of these issues and identify where we can strike the right balance with China in order to, again, address this persistent trade deficit and also elicit their cooperation in addressing some of these geopolitical conflicts with Russia and with Iran.
I do want to talk about a social media post that came from Treasury Secretary Bessent earlier, talking about this CapEx comeback that the administration sees underway. And I thought it was an interesting time for that tweet or post on social media, rather, given that we are really entering the thick of earnings season. So according to your data, I mean, you take a look at this gain that we're seeing in the first quarter, as you say, strongest back-to-back growth since 1997. But you take a look at some of the commentary that is coming out of these earnings calls, and there's still a lot of uncertainty out there. You think about companies trying to plan for CapEx, trying to plan for headcount investments and the like, and it's hard to make policy and make decisions when the tariff stance can change week to week or sometimes day to day. And I just wonder if you're hearing any of that feedback when you have conversations with corporations.
So again, when we look at the data, we see that investments in capital equipment are increasing significantly, and we attribute that to the fact that we just provided enormous tax incentives to engage in new capital investments. So whether it's taking equipment expensing back up to 100%, or it's taking new factory purchases likewise to 100% expensing for the next 4 years, both of those are going to stimulate investment, whether it's R&D tax credits, whether it's the deregulatory activity we're engaged in. If you think about the fundamental shift we took in artificial intelligence, in digital assets, in energy, all of these things are inherently pro-domestic production, and that's why we're seeing this enormous response by businesses in increasing their capital investment well above where it had previously been, and as you said, hitting levels in growth not seen since 1997. So every day we are resolving some of these ongoing decades-long trade issues, but at the same time we're creating enormous incentives for domestic investment because of the deregulatory and tax agenda that this president has led.
What is your confidence that that CapEx is going to lead to reshoring manufacturing in the U.S. with jobs for people as opposed to reshoring manufacturing using robots?
So whether we reshore, we are anticipating that whether the job creation is going to come from the building of the factories, the building of the equipment, and those factories are still going to need people inside them. And so, if you're bringing back a manufacturing activity from abroad and you're bringing it to the United States, irrespective of how much of that manufacturing is done by robots and automation versus how much of it is done by people, there are still incremental people that are being employed, and there is incremental economic activity that is occurring that is to the benefit of the American people. So we are looking forward to generating an enormous renaissance in capital investment and the industrial base here in the United States. And we do recognize that through artificial intelligence, through automation, there is enormous opportunity for productivity gains, and that the skilled labor that is going to be employed in these facilities is going to be high-wage opportunities for everyday Americans.
Well, we really appreciate you making the time for us. We know it's hot out there. That is Michael Faulkender. He is Deputy Treasury Secretary. Really interesting conversation, Scarlett, talking, of course, about Jerome Powell, talking about trade policy, and also talking about corporate spending, CapEx, and corporate plans there. It was interesting to see GM report this morning and say that it would take a $1.1 billion hit to its profit at the expense of basically the tariff stance of the United States.
And of course, the tariffs is not a done deal, right? It's kind of a moving target, as we've seen, as the president rolls out his policies and amends them and updates them for different countries, depending on how negotiations are going.
Exactly. So a lot to keep track of. And I also said that we're in the heart of earnings season. So let's get back there right now, because we're taking a look at shares of Texas Instruments. You can see plunging in the after hours trade following results from the chip maker. Joining us now to discuss is Texas Instruments analyst Jay Goldberg. He works at Seaport Research Partners covering Texas Instruments. It's been a long day, Jay, but let's talk about what we're seeing when it comes to the reaction to these numbers. You've had a couple of minutes to parse some of the details here. What sticks out to you?
So I think the thing that has investors spooked right now is the guidance for earnings next quarter was a little bit light of consensus. By my math, it's $1.48. The street was looking for $1.50. Top line numbers look good. We'll get obviously more color on why there's that disconnect, what's pressuring profitability on the call that's coming up. But I think there's just a lot of concerns about all the things your previous guest was just talking about, or you were talking about with your previous guest. Mm-hmm. What's happening in the broader economy, what's going on there, how's that going to flow through to the profitability of a company like TI?
And let's talk about TI's customers as well. There's a lot of automotive and industrial customers, Jay, and they are, of course, very sensitive to tariff policy, the economic uncertainty. What do we know about how these customers have been ordering semiconductors through this period of the Trump administration as they await some kind of clarity?
I think there is lots of different OEMs, different automakers are handling it in different ways, right? In the U.S., I think the automakers have been fairly conservative. They've been very flexible and sort of have a playbook in terms of adapting to the changes in tariff policy. TI is a very conservative company, just down to its bones. and they've been sort of adapting on the fly as needed. I think the big question they're going to get on the call is, are you seeing pricing pressure? Are you sort of absorbing some of those tariff costs? TI does most of its manufacturing onshore domestically. So where in the chain is this sort of breaking down? I think the U.S. automakers are, they don't necessarily have to be, they have their own problems to deal with. Are they seeing end demand problems? We also have a lot of business coming from electric vehicle makers in China. And that's a sort of a lot of moving parts on that side as well. It's a big source of demand for all the analog companies, and there's been a lot of pricing pressure in that sector. So, I'd be curious to see what the management says.
Well, I'm also curious what you make of the fact that, Texas Instruments into today's close was one of the outperformers, up about 16% on a total return basis for 2025. Could this also be a case of just high expectations?
I think so. There's some of that going on as well. The whole analog sector has had a really good run the last 3-4 months, in large part because these stocks tend to trade around inventory cycles. And last year it was a really bad cycle across industrial for all the analog companies. Inventories started going way up. But then you had last quarter, most of the complex, TI, analog, ON, and the like, started making signals that the inventory cycle had bottomed. And usually the best time to own the stock is from the sort of the trough up to the midpoint, to the mean. That's when the stock really does well, as the inventory cycle is not quite turned the corner, but just about to improve. And that's what we saw here. I think that's what's been driving it. And I think investors are now just capturing some of those gains in the after hours.
Jay, as we look ahead to the rest of earnings season, how much can we extrapolate from Texas Instruments' results to the rest of the semiconductor sectors, especially those that are not touched by the AI linkage to NVIDIA and the high-end chips that there doesn't seem to be enough supply to meet demand for?
Well, in my world now, everything is an AI trade, so it's hard to say. I think the analog companies tend to trade in a very distinct block from the processor companies like NVIDIA and Intel, who are very digital focused. Mm-hmm. So those two aren't always correlated, but over the last year, the analog companies like Texan, like ADI, have gotten on the bandwagon too. They actually do have a fairly decent attached to data center build out around power and things like that. So I wouldn't read too much from Texas Instruments results into, say, NVIDIA's results.
Got it.
Yeah.
All right, Jay, really appreciate your joining us. Jay Goldberg is an analyst at Seaport Research Partners. Thank you so much. And of course, up next, we're going to continue the conversation on tech and speak with Wang. He is chairman and CEO and principal analyst of Constellation Research before Tesla and Alphabet's earnings release tomorrow afternoon. All right, tech stocks stumbled before some high-stakes earnings later this week. We've got Tesla and Alphabet set to report earnings tomorrow after the market closed, and they will kick off the results for Mag 7 companies. Joining us now to discuss is Wang. He is chairman, CEO, principal analyst, and founder. That is 4 titles of Constellation Research. Ray has a buy rating on both of those names, and it is a pleasure to see you in person.
Oh, it's always great to be in studio.
Yeah, usually we see you remote over the computer, so thank you for coming in today. Let's start with Alphabet, because there's a lot of concern that its search business is being eaten by Gen AI. But this is still a business that's making a lot of money, right?
Oh yeah, they're still going to do really well. We're talking 90.93 billion that's going to be coming on that revenue, along with the search and ad revenue that come together. So there's this perception in the marketplace that Google is behind in AI, and I'm going to tell you, it is not true. When we talk to developers, when we talk to system integrators, when we talk to people building, they're building real apps on Google. We had a company that beat another company. They used Gemini with 10 people, 6 months, versus another company doing 130 people and 1 year at half the cost. And so you're starting to see people build and develop on it. And on the search side of things, this is the interesting thing. When you talk to people at Google, a lot of them don't even search, they go straight to Gemini. So you're starting to see the ads and the AEO optimization for AI optimization start to happen.
Okay, so Gemini is Google's solution to OpenAI, but are enough people outside of Google using Gemini?
Yes, and we're actually seeing that. So the war that's going on, enterprises are going to go to Gemini, they're going to shift off of Microsoft and move more to Google first, because there's actually tools that work. There's AI that's on the back end. You're going from chip all the way to the AI application, and it's a lot more effective. We just came back from India. We talked to the system integrators. We asked them what tools are they using. Gemini is top 3 on everyone's list.
And it's interesting, I do want to point out that Alphabet shares officially closed on a 10th straight day of gains today. That is the longest
They
streak.
turned around because they were down earlier.
They certainly did.
Yeah,
It looked like the streak was going to break, but that marks the longest winning streak since 2010. But even still, Alphabet shares, they're only higher by about 1.3% year to date. And it's because there's this narrative that's developed that they're in also ran when it comes to AI. But it sounds like you're saying that narrative is wrong.
We spent 2 Fridays ago with the father of Gemini, and we're watching what they were doing, and it was pretty amazing. Some of the coding, some of the startups, some of the communities that they're building. You're absolutely right. The stock was negative for the year. Now it's 1.3. It's starting to move up. But look at that PE ratio. If you're betting on AI and you're not betting on Google, I mean, you're missing a huge opportunity because that's only upside. Now, tailwinds. Tailwinds are regulatory. Right? We're not sure if the breakup is happening. We're not sure exactly how they're going to navigate it. But you're probably going to see, and the earnings aren't out yet, but you're probably going to see like 9 to 10% growth in all the core businesses. And then there's Google Cloud going at 29, 30% usually. And so I don't know if the numbers have come through yet. So
there's also the other bets division, which I'm very interested in because that's where Waymo is housed. And we've been talking a lot about these self-driving taxis, robo-taxis. But the other bets division expected to post an 18% jump in revenue for the quarter. That's not core, but seems pretty good.
Oh, the other bets is where all the cool stuff is. That's where the scientists are in Mountain View. And so that's anything from new types of energy to what's going on in Waymo to all the other kinds of compute that are coming out in the future, from quantum and all the way out.
Okay, we talked about robo-taxis. You teed me up perfectly for
There we
Tesla
go.
because that's the only thing that matters to Tesla shareholders. It's not about the EV deliveries anymore, is it? It's all about what Elon Musk says about robo-taxis and what their rollout looks like. Is there a whisper number out there that people need to hear from Elon Musk?
I'm going to take a step back and challenge that assumption.
Really?
Investors want to hear robo-taxis, but I'm going to tell them that they're listening to the wrong part. What they should be looking at right now, short-term, is energy business. There's $10 billion on the energy business. People need to have constant energy. The battery pack business is there. The robo-taxis is at least 12 months out. So the energy business is real. So if they double down on energy, that's one. What's beyond the robo-taxi business is the manufacturing, the autonomous, the dark factories. So you're the undersecretary earlier talking about factories coming back. They're going to be dark factories. You're not going to get, there's this romantic notion that we've got people coming back with these factories. They're probably going to be 80% dark factories.
I have to be honest, I haven't heard anyone talk about the energy business for Tesla in a long time, and it doesn't seem like Elon Musk wants to talk about it. So I hear what you're saying, that people should be talking about it. But if Elon Musk doesn't introduce it into the conversation, that factor that you're talking about, can it really start to make a difference in the stock?
Oh, Katie, you're absolutely right. So what we have a situation here is Elon's not interested in the Tesla core business. You need a CEO to actually run the core Tesla business like the way they're doing SpaceX, with a CEO that's loving that business, can rally the troops and do the operations. You need Elon as the ambassador for all new deep tech, right? So that's Grok, that's Optimus, that's what's going to happen in the future in the robo-taxis. Both have to happen at once. And so why people are so interested in having Elon back at Tesla is to focus on the new stuff and then have the lieutenants focus on execution.
All right, Ray Wang, always a pleasure. Thank you so much for coming in today. Ray is chairman, CEO, principal analyst, and founder of Constellation Research as we look ahead to Alphabet and Tesla's results later on this week. In the meantime, let's take a look at how some shares of companies that did report this afternoon are faring. You can see Texas Instruments losing 7.4% after giving a disappointing forecast. The company saying tariffs are disrupting its global supply chain, and the automotive chip sales in particular fell sequentially from the preceding quarter. We also are looking at Capital One, the credit card company and lender, and you can see there that it is up about 1.5%. Second quarter adjusted EPS did beat analyst estimates. And finally, Intuitive Surgical losing about 2% right now. It did narrow its full year worldwide procedure growth forecast there, and it does say that it sees 2025 adjusted gross profit margin of 66 to 67% of its revenue. This is The Close on Bloomberg.
Well, there's more evidence of the growing appetite for deal making today, this time in the food and beverage space. Private equity firm Butterfly striking a deal for its portfolio company, Generous Brands, to buy Health-Ade Kombucha. Joining us live in studio on the heels of that deal, we have Adam Waglay. He is the co-founder and co-CEO of Butterfly. Adam, great to see you in person.
Thanks for having me.
So let's start with the deal. This is an interesting one. Talk us through a little bit of the logic and the timing, since we are starting to see deal making pick up a bit.
Yeah, no, absolutely. Well, very excited to sign and announce this deal today. And Generous Brands, which is a portfolio company we've controlled and been in for some time, is a leader in fresh, clean beverages, so refrigerated beverages. And they have two primary brands, Evolution Fresh, which is in cold press, and then Bolthouse Farms, which is in smoothies, protein, et cetera. And we were always going to grow that organically, but also have always been looking to acquire, really interesting brands that kind of fit that fresh future of beverage category. And actually, the category we've been very focused on is gut health, which is something consumers are really focused on, prebiotic, but also things like kombucha, and Health-Aid's the number 2 in the kombucha space. And while they've done amazing things already, we're very excited about what we can do to take it from here to grow.
Scarlett, I don't know if I've told you, but I have horrible acid reflux. So I can't actually drink kombucha because of the acidity, but it sounds great. And
technology could change that?
Maybe we can get some AI LLMs on the case. But is this a sign of things to come? It feels like any deal that we see in any market, people say, oh, it's starting again. We're really picking back up. Are you looking to be more acquisitive, more consolidation-tory? That's not a word, but you know what I'm saying.
Yeah, absolutely. So all we do at Butterfly is food and beverage, and it's not only the biggest industry in the world, $26 trillion, but it's a very active space no matter what the environment is. So I know we've had a choppy deal environment for the last little while, but we at Butterfly have been really busy. As you know, we talked about Duckhorn, several months ago, and we've been on a buying binge, if you will, and we think we'll continue to be. It's just a space that's really active. Since we started Butterfly, we've looked at 3,000 deals. We've been through lots of different things, pandemics, supply chain disruptions, and now the environment we're in today, but there's always things going on in the food space, and in particular in these better for you kind of high growth categories.
What are you seeing in terms of trends? Kombucha is something that we've been talking about for a couple of years now, but what's on the cutting edge? What's the next big thing in the premium beverage drink space? Yeah,
absolutely. I'd say the big trends are everyone needs more protein. In particular, and we've made multiple plays around that. So Bolthouse has a number of SKUs around that, but just as a firm, we invested in Orgain, protein powders, protein shakes, which we were able to sell to Nestle. A lot of that was plant-based. But also we're investors in the ingredient space around protein. So Actis, which is the #1 manufacturer of whey protein globally. We kind of backed them several years ago, and that's been a real home run for us as well. So I'd say protein is a mega trend, and it can continue to be in multiple different forms. I'd say two other spaces we're very excited about, Scarlett, are energy. Everyone's busy, juggling multiple things, needs more time, and needs that kind of pick-me-up. And so caffeine and energy in multiple forms. Clean energy is kind of really important. And then finally, hydration. We talk a lot about needing to get enough hydration, and that's another space we're really excited about diving into.
So you cover both food and beverage, and I'm wondering how much of these trends that you're seeing, these mega trends of protein, clean energy, hydration, are being altered by people's use of the anti-obesity drugs. I mean, has that pickup continued to accelerate, or have we kind of reached a plateau there in terms of usage of that medication?
Yeah, look, you can't deny these trends. They've made a serious impact, but largely in a positive way for the way we're investing. So we're investing in healthy, better for you, nutrient-dense kind of foods, and those are the foods that are actually getting a pickup from these drugs. These patients are being told they need to eat more nutrient-dense things, like more protein, hydrate better, et cetera. And so we're actually seeing a tailwind from these drugs. I still think that adoption's going and going to continue to be important. And if you look at a lot of the big food companies, are even having to adjust their portfolios and take that into account. So we see that as a tailwind for everything we're doing and something to get excited behind. Well, on the same note, while 80% of what we do is better for you, people still indulge. And that's going to always be the case, right?
Cane sugar Coke.
There you go, cane sugar Coke, U.S. cane sugar. Outside of just what you're investing in, I'm also curious to get your perspective on what fundraising feels like right now. There's a great story on the terminal from some of our Bloomberg News colleagues that these mid-sized private equity firms, it's been harder and harder to get the price they want and also to raise funds. And I wonder if that's been your experience as well.
Yeah, I think, look, fundraising is always hard. I think there's a lot of competition for the dollars and lots of very talented investors. But what we focus on is you really got to differentiate yourself, right? And I think for us, being very specialized is something that I think has been becoming very important. with LPs kind of all around the world. I think the second part of our model is we're super operational and very hands-on when we get involved in these companies. We're not just making investment decisions, but we actually have people on our team who are helping transform caterpillars to butterflies. You can make fun of us if you like, but we're in the transformation business and we take it seriously. And then finally, I'd say for us, we're focused on the middle market. So just to say it, we're investing at this slightly earlier stage where the companies have a lot of opportunity to grow and a lot of ways for us to exit and ultimately sell these businesses.
Gives you maximum optionality.
Exactly.
All right, Adam, always a pleasure. Thank you so much for coming in. Adam Waglay is co-founder and co-CEO of Butterfly, based in LA, but here visiting us in New York. Now, private equity firms also making plays in the world of sports, with team valuations soaring. Our own Romaine Bostic sat down with 3 key players of the newly formed Harbinger Sports Partners, which also boasts Mark Cuban in its ranks. And they sat down earlier today to discuss what's ahead for PE in sports. Here's his conversation with Rashaun Williams, Steve Cannon, and Jonathan Mariner.
I think there is a huge opportunity. There are kind of 3 things happening at the same time. One, there's this macro thesis that's happening where we're seeing $300 to $600 billion of value creation happening over the next decade or so in sports. Number 2, there's the institutionalization of the asset class of sports, where folks that were traditionally venture capital investors or lower middle market buyout investors, private equity in general, now sports as an asset class is an entire new arena that folks can invest in. And then last but not least, the sophistication of liquidity of these private illiquid assets. And I think we're in the convergence of all 3 of those things.
When we talk about the leagues that are ripe for investment, I know I've spoken with you, Rashaun, in the past, obviously about the NBA as well as the NFL. But I am curious, Jonathan, to get your perspective on Major League Baseball and what opportunities you're seeing there.
We think there's a lot of opportunity in baseball. They've got 3 challenges they're looking to resolve over the next several years. One, to try and get a national media package in light of the collapse of the cable bundle. Number 2, they're looking to get some parity across payroll, competitive balance. And number 3, they've got this revenue sharing issue that a lot of the big market clubs are trying to resolve. We think that once those get resolved, franchise values will absolutely take off, such as we've seen in the NBA more recently.
When you're looking for teams that are attractive, Jonathan, I am curious as to sort of what's the metric you look at. And I mean beyond just the overall financials. I mean, when you're looking at the cities, the population, maybe the potential support you're getting for the government, what goes into that process?
I think all of those are key factors. Obviously, the market size is going to be important. A lot of the team success is based on the consistency of the on-field play. So looking at the minor league system, player development system, going to be very important. And obviously, the stadium environment, you look at a team like the Atlanta Braves that's created this huge revenue-generating opportunity. Those are all going to be factors that weigh into our valuations.
I am curious, all of you have very distinct backgrounds that seems to have set you up for where you are today. And I am curious, Steve, if maybe you can kind of expand on the idea of what you're doing today and maybe how that connected with your previous life with Mercedes-Benz and in that ecosystem as an executive.
So I got this amazing opportunity to live what I call sports 2.0. So the key to unlocking economics in sports is to build a new stadium. And there is a huge replacement wave that's coming. If your stadium, ballpark, or arena is 20 years or older, chances are it doesn't meet the demands of the modern fan, number 1. And number 2, you can't charge premium economics if you don't have a premium product. So it all starts with building the stadium, arena, or ballpark. I call it building Disneyland. You've got to build a really compelling place because consumers consume sports much differently than they did just a few years ago.
So I'm curious then, Rashaun. I mean, he makes a good point. I mean, when we talk about the people who are buying into this, I mean, traditionally it has been obviously the highest of high net worth individuals, the billionaires and their family offices. But you're seeing sort of a next tier down of wealth also wanting a piece of the action. How do you sort of reach those folks?
I think eventually you're going to have every single segment of the population owning sports teams. And we just aren't there yet. So you have the billionaire, family-owned businesses that you've seen over the last few decades. In that case, over the last 100 years, actually, NFL, NBA, MLB. And now you're going a little downstream where even millionaires can become minority owners. Only 1% of a $5 billion team is a $50 million check. So you still have a very small small percentage of the population that can do that. But these are people from all around the world. And then even further downstream than that, you know, private equity funds are raising money from banks, from financial advisors, from RIAs, and they're creating these SPVs where hundreds and thousands of retail investors can now invest $250K or $500K into a sports team underneath an SPV led by a large private equity firm. So eventually fans are going to own these teams. Right now it's largely dominated by those three different capital sources.
Jonathan, I am curious about the folks who are selling their stakes, whether it's the whole team or certain stakes of the team. Is there a sort of a pattern that you're seeing in the reasons why we're seeing that type of selling?
I think you're seeing three categories of people looking to sell. On the one hand, you have some owners just looking to raise additional capital. And with these inflated or these much higher valuations, it's a great time to raise capital, just like you would in the other commercial markets. Number two, you have people who are, for estate planning purposes, looking to sell out a stake. You may have a patriarch or matriarch who owned the team, who passed away, and for estate planning purposes, the next generation looking for liquidity, looking for a change in how they might want to allocate assets. And then you just have other LPs who simply have held for a period of time, and they're saying it's time for me to get out. I mean, given these valuations, it's a great time to take some chips off the table.
With regards to the types of sports that you're most interested in, I mean, I understand the appeal, of course, of the big three sports here in the United States and a couple other ones like soccer as well. Are there other sports kind of below that maybe aren't quite at sort of the peak that you see in the NFL and NBA, et cetera, that also entices you?
Our focus at Harbinger is going to be on the three major sports leagues at this point: basketball, football when we get to a certain size, and obviously baseball. We think those are mature sports with a proven business model, proven profitability, and proven demand for the product. You know, there are other sports out there, pickleball and other newer sports. One of the things they don't have that the three leagues we're thinking about investing in are media deals, and that's a huge economic engine that really drives the profitability of these franchises.
And the media deals, I assume, guys, that is kind of the crux of where you look for the revenue and profit growth?
Yes, without question.
And our thanks to Rashaun Williams, Harbinger Sports Partners founder and CIO, Steve Cannon, co-founder and CEO, and Jonathan Mariner, the general partner there. Really interesting conversation with our own Romaine Bostick.
And earlier today, there's some sad news. Ozzy Osbourne, he, of course, is the self-styled Prince of Darkness, the lead singer of Black Sabbath, passed away, died at the age of 76. Of course, he really defined heavy metal and is seen as like the original heavy metal star. And this was, you know, a big surprise in many ways because he had just performed at a farewell concert earlier this month, but he had been suffering from Parkinson's disease for a while now.
Absolutely. I mean, that's good context there, that he did have Parkinson's, but 76 years old, I think it took a lot of people by surprise. And you were actually in Birmingham. You didn't go to the concert, right? But you were there.
My husband went to the concert with his friend, and I was wandering around Birmingham, and I saw the museum exhibit devoted to Ozzy Osbourne because the entire city was decked out to celebrate Ozzy Osbourne. I went in, I watched the exhibit, I watched footage of live concerts. I took a picture of myself with a mural of him around this,
with the
street.
Prince of Darkness.
With the Prince of Darkness. That's me, you know, doing the peace sign with the Black Sabbath mural. Yeah, it was, the whole city was celebrating him. It was pretty remarkable, this farewell concert. It was the last of its kind, and all these heavy metal bands came out in homage of Ozzy Osbourne.
Yeah, and it was funny. I mean, the news broke, and I was sitting in the newsroom, and he really spanned generations. I mean, Black Sabbath, he was in it from 1968 till 1979. I wasn't close to alive, but you think about the reality show, the Osbournes, it really, I mean, it touched a lot of people.
That was really brilliant in a way because, and it was engineered by his wife, his manager, Sharon Osbourne, but it really introduced Ozzy Osbourne to a whole new generation of fans that he probably wouldn't have found otherwise. So once again, Ozzy Osbourne passing away at the age of 76 from Parkinson's disease. All right, time to help you look ahead to what we're watching over the next 24 hours. We're on Earnings Watch. In the pre-market, Katie, you are going to be helping to break what, Hilton, AT&T?
Yeah, and that's exciting, but the real action is after hours. You're going to be breaking Tesla, Alphabet, IBM, ServiceNow, Chipotle, Las Vegas Sands, CSX, the list goes on.
Yeah, it's a big cross-section of the overall economy, but those big mega cap tech names matter a lot. 10 a.m., U.S. existing home sales numbers, and of course, that's the biggest part of the U.S. housing market.
We also have the ECB, their two-day monetary policy due to start in Frankfurt. Just a little, appetizer for the Fed next week.
And of course, tomorrow, President Trump plans to outline his AI priorities at an event titled Winning the AI Race. That does it for us. Balance of Power is up next.
Have a great evening. This is Bloomberg.